Welcome to Money Wise with Brian, and as you know, my name is Brian Alexander. So today we are going to be talking a little bit about focusing on investing monthly to build up your wealth over time. Investing monthly to build up your wealth over time. So why do investors consider to invest monthly for a long term? Why a long-term vision? And why do investors consider investing monthly for a long term? So here are some of the reasons that they were looking at. Firstly is pension. So pension is something that can be needs to be a substantial amount of wealth to be able to cater for the same amount of funds that you were living off on a monthly basis. You still want to continue into your later years and when you're on pension. So pension is definitely one. And the longer the time that you have, the better that your interest is going to build up. It's called compound interest. So you're giving that time for it to grow upon itself and upon itself and upon itself over time. So pension is definitely one of them. Another one is that people consider is for college education. And normally they try and do that on a 15, 18-year term. And it gives them time to be able to accumulate enough monies. And right now it's probably the aim is to make it around about 80,000, but that's today's terms. So you've got to take inflation into account. And so over a 15-year period, you might want to double that money or just a little bit more than double that money. So it might be $200,000 that you're looking at to try and accumulate over a longer term of time. Now, some of these sums that you might have to try and get to might look large, but when you give it time, it's on your side. If you're only giving it a few years, it becomes difficult. And there are other things like you're saving towards a deposit for a property. Maybe that's 5 years' time. You want to purchase a property and you need a deposit where you might need 50 or 100,000 or maybe more in cash to put down. And so these are some of the things that you can save for a period of time. It's not a short-term tomorrow's goal. So those are some of the things that we would tend to want to utilize this monthly saving. And funds are normally invested offshore. Why would that be? Well, if you're going to invest your funds offshore into hard currencies, in other words, dollars, Australian dollars, US dollars, euros, pounds, that type of thing, that's going to give you an opportunity to have a stable currency that is not depreciating. So you don't want to necessarily be investing in a currency that's depreciating. There are certain currencies around the world in third world countries that have a consistent 10-20% decrease per annum. So you think you're saving, but you're not, because you have this value loss, and then suddenly you send your child off to education and you realize that your currency has lost its value. So investing offshore is extremely important into a hard currency. Are the investors' funds secure? Of course they are. They're invested with all the largest institutions that are registered with all financial services boards around the world and in various different countries, into the largest countries that there are, and are the largest institutions. So surely they are definitely secure. The general market movements and fluctuations, how do they affect your investment? Well, of course, they are going to. We've had some interesting times over the last 2 or 3, actually, in fact, 4 years, 3 to 4 years. We've had some major fluctuations, decreasing by 20%, increasing by 20%. It's just been quite an interesting bear markets, bull markets, sometimes not knowing what's going on. But the interesting thing about those fluctuations, although it can affect your investment, you've got to keep in mind that what they call dollar cost averaging. So in other words, if you're investing on a monthly basis, you get an average. You purchase those shares at an average price on a consistent basis. So you're never having this, you bought it too high and now you've lost money. You're actually buying low, you're buying high, and in the end, it averages itself out. And over a longer period of time, that your dollar cost or euro cost or pound cost averaging, it's going to average, that's why they call it averaging, it's going to average itself out over time. So you'll find that your money will still grow. You're not trying to time the market. You're not trying to get in at the right time. That type of thing you want to, when you start investing a lump sum, that's a different scenario. Then you want to be in at the right time. You want to buy low and allow it to grow over time. So dollar cost averaging, euro, pound cost averaging, it's all the same. It gives you the opportunity to also buy and low. You don't have to worry about it. You can put it in and allow it to grow in its time. So what are the benefits of investing in this particular way? Well, at the end, you're allowing compound interest to work on your benefit. As I said, you've got time on your hands and it can grow and you don't have to worry about whatever fluctuations happens in the market. And so who's going to help me to make sure my investment is always working correctly? Well, we as the investment side, we have MoneyWise with Brian, as you know. That's me independently. I will assist you and give you advice on a continual basis. I can meet with you quarterly, every 6 months, and just give you some ideas of what's happening with the market and what's happening with your current investment. And if it's working well, we leave it. If it's not, we revisit it. However, at the same time, with Lawson's, the other side of our business, who we are affiliated with, they have an investment committee that is always giving us insight into what the market's doing and will assist to make sure that all of our clients' funds are being invested correctly. So you have a double-sided side to this. You have an investment committee and you have myself also assisting you to make sure that your investment is growing as it should. Now we remember always there's going to be fluctuations in the market, but we're looking on a long-term basis always. And that's always the question that I'm always asking when I look at your investment, and that is, what's it going to do over the long term? How do we foresee this particular fund growing in the long term? And that's what's key when we are looking at any particular investment or any particular fund. And we obviously have a variety of funds that you can choose from. So if I want to see my money grow quickly, or maybe I'm a very cautious person, what happens then? So if you're looking to have a quick growth, or you're looking to have more of a cautious, we look at what your risk profile is, and according to your risk profile, we will position your investment so that you are always comfortable that it's growing at the right pace. So we're always trying to match the pace of the investment to how you're comfortable with actually investing. So it's very important for us to understand you as an investor and as a client, so that we make sure that we're continually meeting your needs on a regular basis. Now the market, like I said, is a thing on its own, but in the end, we are always giving ourselves time for that to be effectively worked out. So can I draw money or stop my payment at any time? Absolutely. There's always a cash value in our current investment that we have and the product that we have. So you are able to draw cash if there comes a circumstance that you need cash at any given stage. And if you need to stop payment, you can do so and take a period off. You can catch up, or you don't have to catch up. If you don't catch up, well, then you're going to obviously not maybe meet the target that you set out. But that is a discussion that we will always have. But you can certainly draw money or stop payment at any given stage. There are some products in the market that you can't do that at all, but our current product you can. So when in my life cycle would I begin investing? Well, it's a very simple. Where would I start? Where should I start in my life cycle? Well, there are two places. It's yesterday and today. If you're waiting for tomorrow, you're likely tomorrow going to put it off again and again and again. And if you look back 5 years and you said, well, you know what, I could have actually saved $500 a month. That's $6,000 a year. That's $30,000. You add some interest to that, you could have been on $50,000 with interest over a 5-year period, simply by contributing $500 a month. If you had contributed $1,000 a month over a 10-year period, then you would have been on around about $250,000 over 10 years. So if you look back, where could you have been now? So let's forget about looking back. The best thing to do is start today. So who generally is my client? Well, I have a variety of clients. I look after various different clients, whether it be corporate clients, moving and assisting them with their extensive wealth. And there's the clients that are everyday working accountants and administrators, and I assist those as well. So I tend to be open to a variety of clients. The client trusts me, I trust them, and I build up a relationship with every single client, and I assist where I can. My final piece of advice then, for anyone that's desiring to grow their wealth and contribute on a monthly basis, whether it be towards their pension, whether it be towards their child's college education, towards a home they're looking, or they just want to invest at the moment. What is my final piece of advice? Well, sit down with an appointment with myself and let's look at the various different strategies that you have and how that we can achieve a goal. Let's make sure that our goal is clear. I think that's one of the key things. If I had to give my final piece of advice, many of us want to go on pension in a great manner. We want to be comfortable on pension. We want to be able to provide for our child a great education. So we have these goals, but a great education, a comfortable pension is not really a goal. It needs to be, well, I need to be able to attain 1.5 million on pension. If I have 1.5 million in 15 or 20 years time, then I will have sufficient monies to be able to go on pension. Okay, so fine. So currently, then I'll be asking the question, so what do you have now? What are you contributing? What is your current balance at this point of time? So what will that be in 10 or 15 or 20 years time? Okay, so you're going to reach $1 million. Okay, so we're 500,000 short. We've got 20 years to reach it. Therefore, we're going to have to contribute X amount with certain factors involved, different, taking interest into account and compound interest and various different factors. What do we think we're going to need to contribute to get to that 500,000? So the sooner that you sit down and have that discussion and make your actual goal a little bit more clearer will certainly help you. That would be my final piece of advice. Let's have a meeting together. Let's have a discussion about your goals down the road so that we don't have that situation where we have 2 years or 5 years to go. We're trying to sort out our pension value or our college education for our child. Thank you for listening. I appreciate it and look forward to you to contacting me, and we're setting up an appointment and we'll have a discussion, and truthfully, I trust I will be able to assist and help with your needs. Thank you so much and look forward to speaking to you soon.